All right. So I guess like for starters, the number one thing, if you kind of see a deal that comes across to you, two pieces of information are going to be the most essential. And this is where I'll share my screen if it loads up. There we go. The first of which is just a rent roll. So you guys see this?
Yep.
Okay. And a rent roll is very basic. All it is a list of every unit in a property, how much or size, bedrooms, what the lease term is, rents, and that's it. Usually tenants are listed too, but this is a fake rent roll, so there's nobody listed here. The information we pull from here is pretty simple. It gives you that starting point, like basic information. How many units are there? What am I trying to buy? What does the unit mix look like? So that's something we always look at. For us, it's understanding, okay, there's 40% ones, 40% twos, and 20% threes in here. Is that something in a given market that is important to people? Or if you're living downtown, a lot of people who live downtown tend to live alone and want smaller spaces, whereas you go out to the suburbs, you have a lot more families looking for 2 and 3 bedrooms. So product mix, depending on location, typically kind of matters. So this rent roll, everything is completely made up. Market rents are something you should be kind of plugging in. Basically, never trust anything that's given to you unless someone's actually paying that money. The difference between market rents and lease rents is very simple. This is what they're actually, that's what they're actually paying. This is what they aspire to be getting. So ideally, in the example of this first unit, when this person moves out at the end of May, they're probably going to bump the rents to $1,800 so that they can maximize their rents. And then one thing that's always kind of top of mind that as you get or start to pull in information, you're looking at an investment, loss to lease. Basically what this is the delta between these two. Because you have this person living here, what money aren't you making? So if this person didn't live here, we'd get an extra $100 a month out of this unit in the simplest form. Second thing you're probably going to get is an operating statement. This operating statement I kind of slapped together pretty quickly, but these are kind of general things that you look at and that'll be provided to you. It's income over the year or several years, depending on how much information you get. You can set your market rents or you can kind of go with whatever they provide. Existing historical vacancy, other income, things like pet rent. I don't know how many of you guys live in full service buildings or at this point, but just any sort of other fees that get charged kind of get lumped in there. And then your expenses. On the plus side, smaller properties like this, your expense load is a little bit lighter. Here, I just kind of started to think of the heavy hitters. So repairs and maintenance. So things you need to replace, flooring, paint, stuff like that. Landscaping, if you have it and you need it. Real estate taxes are the single largest and most important expense you should understand making any investment. Insurance is kind of right behind that. Insurance varies based on where you're buying. So for instance, insurance in Boston, substantially cheaper than insurance in South Florida, where Will is, although he's on the West Coast. Primary reason, hurricanes and floods. So understanding the different things outside of just kind of a base policy, like what could also influence this? Parts in the Midwest, hurricanes, not hurricanes, tornadoes, like things you wouldn't otherwise think of if you've never been to the place. Utility costs usually paid for by the tenants, but there are always costs associated with it. And then a management fee, if applicable. In this case, I threw one in there. You could simply just say it is nothing, and let it go away. Most places charge a management fee. If you were to go buy a place with a decent unit count, you probably want to charge one because you're basically paying it to yourself. But again, up to you, depending on how you want the cash flow to come. So for the sake of this, it kind of brings you into the next step. You start to look at these two things, rent roll, operating statement, and you have to develop what you think your year one is going to be, but how do you do that? The easiest way is to break down the historicals. So the way we always look at everything for a stabilized property, which basically means it's not brand new. You're not trying to bring people in to rent for the first time. It is an existing asset that has had leases for years and years and years. As you kind of look at it trailing 3 months, how did it look? Was it good? How's the performance there? And then over the trailing 12 months of expenses, because your hope is that if you annualize those 3 months, you can build off that trajectory and kind of keep increasing rents at that pace. So T3 over T12 is kind of our general jargon. This is typically how most brokers, most buyers will kind of characterize their acquisitions. If they start quoting you cap rates or anything like that, this is what they're kind of basing it on. From here, you kind of build out a pro forma. I went ahead and kind of filled in the in place. So this here again ties to the T3, T12. But with you guys, it was kind of, all right, what do we do for year one? How do we build out those assumptions? So I haven't really spent any time playing around with these. Everything's just flat. And that's what I was hoping kind of we could do together.
Mike, real quick, Alex has a question. Do you want to keep all questions towards the end, or should we just do it?
No, do it iteratively. My throat's gonna dry up. It's gonna be bad.
Perfect. Alex?
Yeah, I have a question about the management.
Sure.
Are you, when you, like, do you create another entity that manages it, that you send that money to, or do you charge yourself? Because would that then be an expense that you're paying to yourself that you could like write off?
Yeah, so it depends. So for instance, the way Northland that I work for, we are so all of the properties that we own pay a fee to us as the management company. So yes is the answer to your first question. You set up a separate entity or a management company that then owns the asset and can take this fee off the top. Our properties also cover payroll. So everyone who works on our sites are paid for out of the expenses or out of the income of the property instead of kind of us paying them on the back end through the management fee. So it is truly just a fee that you could pay to yourself. Yes. All right. Any other questions so far?
Yeah, I actually had a question.
Sure.
So back in the trailing operating statement, I was just wondering. So how come, putting money aside towards capital expenditures as an expense, it's not in this model?
So ordinarily it would be. I just kind of left it out for simplicity's sake.
Okay.
That is something you would put below the line. And when I say that, I mean literally. So here's your net operating income. This is what everybody prices deals and operations based off. You would have all of your capital kind of down here to factor in your net cash flow.
And will that also include like vacancy rates?
Nope, vacancies up top.
Oh, okay, sorry, yeah, I didn't see that. Okay,
Yep.
All right, got it. All right, thank you.
No, it's because capital you can build into the basis of your deal. So it's more of a tax issue than anything else. And so like, here's your operating performance. Capital is a reinvestment. So it's like you're reinvesting that into the asset instead of just taking it out. Whereas you can kind of do whatever you want with net operating income. In theory, you should probably pay your debt, but that's where that is. That's why I just kind of left it out for simplicity's sake.
Okay, all right, thank you.
No problem.